What is the spread in futures markets? Exactly like any other market, futures contracts trade with a spread. The spread is the difference between the price at which you may buy and the price at which you may sell. The buy price is always higher than the sell price at any given moment. This means that if you buy a futures contract and immediately sell it, you will bank a loss equal to the spread. Let's consider an example. Suppose that at this moment the bid size is 252, which means that there are buyers prepared to buy a total of 252 contracts at the price of 1984.75. Additionally, upon examining the number of sellers, we observe that the ask size was 19, meaning that there are sellers prepared to sell a total of 19 contracts at the price of 1985.00. The spread is the difference between these two prices. In this case, the spread is simply one minimum price increment, or tick, and this is normally the case for any liquid futures contract. If you were looking at price quotes for a stock or a currency, however, then there would almost always be a wider spread, with a greater number of prices between the highest bid and the lowest ask. In this example, if you want to buy a contract and be guaranteed that your order will be filled, then you must cross the spread and pay the lowest ask price of 1985.00. While this ensures that your order will be filled, many traders, such as those visible in the price quotes, are more concerned with the price at which their order is executed, and they therefore prefer to place limit orders. Their orders may or may not fill, but if they do fill, they will not have had to pay the spread. Moreover, the counter-derivatives markets, such as forex or contracts for difference, the person you buy from or sell to is always your broker, and by lowering the price at which they will buy from you or raising the price at which they will sell to you, they are able to control the spread. For such financial instruments, the spread can be widened at the broker's discretion, though you may choose not to trade at the prices offered. In this way, the broker is able to profit from the spread. Futures markets are completely different. The counterparty to your trade is not your broker, but another trader. All that your futures broker and the futures exchange do is to match your order with that of another trader just like yourself. There is no incentive for the broker to widen spreads in the futures markets. This means that spreads in futures are very narrow compared to most other type of instruments such as forex. Typically, they are as narrow as it is possible for them to be, just a single price increment or tick. Tight spreads mean that your costs to enter or exit a position in futures are reduced, potentially making it easier to profit from trading in these markets. A futures broker makes their money not through the spread, but through a commission, which is a flat fee per trade. Commissions may or may not make trading futures more cost-effective than other instruments, but commission does have the added advantage that the precise cost of trading is known in advance and can therefore be factored in when testing strategies.